Good morning, friends. We are now going to start with the important topic of partnership, which is joint life policy. Many students find it very difficult. The joint life policy is difficult, sir. We don't know what are the entries, how to proceed, how to be studied, how to remember. So, here I am to explain the concept joint life policy. First of all, uh, who takes out a joint life policy or who takes a joint life policy? First of all, partnership firm will take a joint life policy to protect the life of the partners and overall, if anything happens to a partner, if anything means what? If a partner retires or if a partner dies, then the policy amount will be received by the partnership firm, which will indirectly benefit the firm due to the loss which has occurred ड्यू टू रिटायरमेंट ऑफ पार्टनर और डेथ ऑफ पार्टनर. मतलब एक जॉइंट लाइफ पॉलिसी क्यों ली जाती है पार्टनरशिप फर्म से? ताकि रिटायरमेंट या डेथ होती है अगर पार्टनर की तो बहुत नुकसान हो सकता है पार्टनरशिप फर्म को, तो उस नुकसान से बचने के लिए जॉइंट लाइफ पॉलिसी ली जाती है बाय द पार्टनरशिप फर्म. नाउ जॉइंट लाइफ पॉलिसी का मतलब होता है कि दो तीन या चार पार्टनर्स है तो सबका एक कंबाइंड पॉलिसी लेते हैं जिसका प्रीमियम फॉर्म भरता है. जिसका प्रीमियम कौन भरता है? फॉर्म भरता है. तो जो प्रीमियम भरेगा, जो खर्चा करेगा, उसको ही बेनिफिट मिलना चाहिए. यस और नो फ्रेंड्स? द आंसर इज यस. सो नाउ लेट्स स्टार्ट विद द कॉन्सेप्ट जॉइंट लाइफ पॉलिसी. आई हैव ऑलरेडी डिस्कस्ड द इंट्रोडक्शन पार्ट. A partnership firm may decide to take a joint life insurance policy on the lives of all partners. The firm pays the premium and the amount of policies payable to the firm on the death of any partner or on the maturity of the policy whichever is earlier. अब ये सेंटेंस सिंपल इतना बोलता है, या तो पॉलिसी का पीरियड मैच्योर हो जाता है, मतलब समझो एक पॉलिसी लिए 20 साल के लिए, तो या तो 20 साल खत्म हो जाएंगे वो, या तो किसी पार्टनर का रिटायरमेंट होता है या कोई पार्टनर की डेथ होती है, विच एवर अकर्स अर्ली, उस टाइम पे आपको पैसा मिलता है फ्रॉम द इंश्योरेंस कंपनी. नेक्स्ट, the objective of taking such a policy is to minimize the financial hardships to the event of payment of a large sum to the legal representatives of a deceased partner or retiring partner. Now, main intention of taking such joint life policy is to protect the firm, to protect the lives of the partners, to protect the lives of the representatives of the retiring partner or the deceased partner. मतलब जो मर गया या जो रिटायर होता है उसके पीछे के रिलेटिव्स या उसके फ्रेंड्स जो भी है उनको पैसे का पेमेंट करना पड़ता है. इसके लिए पॉलिसी ली जाती है ताकि ये इवेंट ऑफ इन द इवेंट ऑफ रिटायरमेंट होते हैं, तो अगर कोई पार्टनर रिटायर होता है या किसी की डेथ होती है तो इंश्योरेंस कंपनी पैसा देगी और वही पैसा उनके लीगल हायर्स या उनके रिप्रेजेंटेटिव्स को बांटा जाता है. Now, the accounting treatment for premium paid and the joint life policy may be on any of the following ways. Now, when a firm purchases a joint life policy, the premium is also paid by the partnership firm. Now, the accounting treatment can be done in three different ways. First approach is when the firm pays the premium paid is treated as an expense. The premium paid is treated as an expense. So that's it. When the premium paid is treated as an expense, when premium paid is treated as an expense, then it is closed every year by transferring to profit and loss. In short, very simple. जब भी फॉर्म पार्ट प्रीमियम भरता है और उसको एक्सपेंस बता दो तो क्या एंट्री पास करेगा? जेएलपी प्रीमियम अकाउंट डेबिट टू बैंक, जेएलपी प्रीमियम अकाउंट डेबिट टू बैंक. And then nominal account होने की वजह से, since it is a nominal account, it will transfer to profit and loss account. So in this case, complete amount received from the insurance company either on surrender of a policy or death of a partner becomes a gain. Now, whenever firm follows expense approach, so what entry form will pass? JLP premium account debit to bank. Every year JLP premium to bank and every year transfer that premium to PNL. So PNL account debit to JLP premium. So first entry will be payment of premium, JLP premium account debit to bank, then transfer of premium, PNL account debit to JLP premium. So whenever any partner retires or whenever any partner dies or there is a death of a deceased partner or whenever a partner dies, the firm receives the amount from the insurance company, which is a total gain for the insurance company. Why it is a gain? Because the premium bhara tha, to it is shown as an expense, but whenever the company receives the policy amount or the surrender value or any amount from the insurance company, the entire amount received is a gain. In short, whenever the firm pays premium and the firm shows the premium paid as an expense, then whatever amount the firm receives from the insurance company in the event of retirement or that, it's a total gain to the partnership firm. Fine. Accounting entries on payment of premium, it is JLP premium account debit to bank, JLP premium account debit to bank. Then since it is shown as an expense, all expenses are nominal accounts and all nominal accounts are transferred to PNL account. So next entry will be P&L account debit to JLP premium. Next, whenever a policy matures, the entry will be bank account or insurance company account debit to partner's capital. So guys, just remember 3 steps. I'm writing on the screens for you. First is payment entry, payment of JLP premium. Second is transfer to P&L. Third is maturity of policy. Maturity of policy. So basically, JLP premium account debit to bank, P&L account debit to JLP premium, and whenever the insurance company receives amount from the insurance company, whenever the business receives the amount from the insurance company, the entry would be bank account debit to partner's capital account or insurance company account debit to partner's capital account. I hope it is very clear. The first approach, that is a premium paid, is shown as an expense. Now, what is the second approach talking about? When the premium paid is treated as an asset, means whatever premium firm pays, firm does not show it as an expense, firm shows it as an asset. Means firm is thinking that whatever premium firm is paying, firm is treating that as an investment or as an asset. So in this case, insurance premium paid is first debited to life policy account and credited to bank account. So instead of debiting JLP premium account debit, the firm will say JLP account debit to bank. At the end of the year, the amount in excess of surrender value is treated as a loss and transferred to profit and loss. Now, the amount in excess of surrender value. Before going for this point, I would like to discuss one thing. In case of retirement, the firm receives surrender value because the partners voluntarily retire on their own and the policy is yet to mature. Means partner अपनी मर्जी से रिटायरमेंट लेते हैं and the policy is yet to mature, मतलब अभी भी पॉलिसी का मेच्योरिटी नहीं है. तो in case of retirement, partnership firm will get surrender value, and in case of death, because death is a natural event, death occurs at any given point of time, so in case of death, partnership firm will get the policy value. So please make a note of this. I'll write here important points with a blue pen. In case of retirement, you will get surrender value. In case of death, you will get policy value or maturity value, whatever you feel appropriate. So whenever a partner retires, you will get surrender value. You will means partnership firm will get surrender value, and whenever there is a death of a partner, the partnership firm will get policy value or maturity value. Now I am concentrating on the point when premium paid is shown as an asset. What entry firm will pass? JLP account debit to bank. Instead of using the word JLP premium, the firm will say JLP account debit to bank. Now at the end of the year, the amount in excess of surrender value is treated as a loss. Means every year the firm pays premium. Every year the surrender value keeps on increasing. Let's assume firm pays premium of 1000 rupees per annum. So every year after completion of first year, firm paid a premium of 1000 and the surrender value is nil. After the completion of 1 year, the surrender value is nil. So in this case, the entire 1000 rupees which the firm has paid is a loss to the company or it is an expense to the firm. Hence it is transferred to P&L. Second year, again the firm will pay 1000 rupees premium. But after second year, the surrender value, let's assume the surrender value is 900. So till now, how much premium firm paid? 2000. 1000 for the first year, 1000 for the second year. How much premium did the firm pay? 2000. What is the surrender value after second year? 900. So what is the loss? 2000 minus 900, 1100 is the loss which should be transferred to P&L. I hope it is very clear. So whenever firm pays premium and it shows as an asset, the entry will be JLP account debit to bank. At the end of each year, there will be a surrender value given. Difference between the premium paid till date, and the surrender value is either profit or loss for the partnership firm. So in short, the difference between the premium paid and the surrender value is either a profit or a loss which should be transferred to P&L. In this case, the amount received from the insurance company in excess of surrender value results in a gain at the time of receipt of such amount, which is transferred to capital account of the partners in the PSR. So what I am trying to say again and again, when the firm pays premium and shows it as an asset, what will be the entry? JLP account debit to bank. At the end of each year, there will be a surrender value given in the problem. Let's assume in our example, firm pays 1000 rupees premium annually. At the end of first year, the surrender value is nil. So what is the difference between the premium paid and the surrender value? Can I say premium paid is 1000, surrender value is nil. So entire 1000 rupees loss should be transferred to P&L. Second year, again the firm pays a premium of 1000 rupees. Against that, the surrender value at the end of the second year is 900. So firm will calculate cumulatively. What is the total premium paid till date? 2000. 1000 of the previous year, 1000 of the current year. So what is the total premium paid? 2000. Against that, what is the surrender value given? 900. So what is the loss? 1100. 1100. There is 1100 is the loss which should be transferred to P&L. Okay. So this is it. What I was trying to say. Now I'll repeat one more thing. Whenever a partner retires, the firm will get surrender value. Whenever a partner dies or whenever there is a death of a partner, the firm will get policy value or maturity value. Now, as far as you can see this third point, creation of joint life policy reserve, that's not so important or not to be discussed right now. Let me discuss first. I'll discuss that, but later on. But let me discuss the first two approaches by an illustration which is given in ICI module. Illustration 7. Red, white and black shared profit and loss in the ratio 5:3:2. What is the ratio? 5:3:2. They took out a joint life policy in 2018 for 50,000. This is policy value. Premium of 3,000 being paid annually on 10th June. Every year the firm pays a premium of 3,000. The surrender value of the policy on 31st December of various years was as follows. At each year ending, surrender values are given. So in the year which the firm purchased policy, the surrender value is nil. 2019, the surrender value is 900. 2020, surrender value is 2000. 21, surrender value is 3600. Black retires on 15 April 2022. Means Black is a partner who is retiring on 15th April 2022. Prepare ledger accounts assuming no joint life policy account is maintained. So the firm is treating the premium paid as an expense. Firm is treating the premium paid as an expense because it is clearly mentioned no joint life policy is maintained. I hope it is clear. Let's start with the solution. So let's start with this illustration. I'm just showing you the solution which they have given and I'll explain one by one. So no joint life policy account is maintained means the firm is treating the premium paid as an expense. So what is the premium paid every year? 3,000. The firm will pass an entry JLP premium account debit to bank 3,000. Then since it is an expense approach, P&L account debit to JLP premium. Same way the firm will continue in the next year. There is 10 June 2019 JLP premium to bank. P&L account debit to JLP premium. Then next year 10th June 2020 JLP premium account debit to bank 3,000. P&L account debit to JLP premium. Again next year 2021 JLP premium account debit to bank and P&L account debit to JLP premium. Now Black retires on 15th April 2022. So in this year 15th April 2022 means the year is not yet over. So the partnership firm will get surrender value of 3,600. Surrender value of how much? 3,600. So what entry partnership firm will pass for that? They have prepared a joint life policy account and stating that the policy amount is received because a partner retires. So the entry is bank account debit to JLP 3,600. Bank account debit to JLP 3,600. And 3,600 will be distributed among the partners in the ratio 5:3:2 as the ratio is given. So 1,800, 1,080 and 720. So this is how expense approach works. Every year you have to say JLP premium account debit to bank and P&L account debit to JLP premium. In the year of retirement or death, whatever the case may be, in case of retirement, the partnership firm will get surrender value and the value will be distributed among the partners in their PSR. So this was joint life policy approach in where premium paid is shown as an expense. Now guys, one more thing I would like to say. When they have mentioned that when no JLP account is maintained, just open JLP premium account. No need to open this account unless and until they have asked. No need to open this account also unless and until they have asked. because joint life policy account इन्होंने यहाँ पे बताया मतलब वो asset approach की तरफ जा रहे हैं. They are just trying to show here joint life policy account the way money is distributed among the partners. So whenever they say no joint life policy account is maintained, just prepare joint life policy premium. I hope it is very clear, guys. Now we'll go with the same illustration, but here asset approach has to be followed. See, the same question is given, ratio 5:3, annual premium 3000, this is policy value, and these are the surrender values given. Black retires on 15th April 2022. Prepare ledger accounts assuming JLP account is maintained on surrender value, means you are following asset approach, and till the time you submit the policy or you surrender the policy, in every year there is a value which is calculated by the insurance company, and that value is known as surrender value. Now whenever you are following asset approach, you need to remember one thing: the premium paid is not treated as an expense, the premium paid is shown as an asset. So what entry the firm will pass? JLP account debit to bank. JLP account debit to bank. And what is the surrender value in year number 1? Nil. No surrender value. So can I say entire premium paid is treated as a loss, of P&L account debit to JLP. P&L account debit to JLP. Next again firm will pay premium and show it as an asset. So they will say JLP account debit to bank. They will say JLP account debit to bank. Now what is the surrender value given in 2019? 900 rupees. So they will say buy balance carried down 900 because this is the value receivable if we surrender the policy, and if we balance there is a loss of 2100. Again that surrender value will be brought down. Again premium paid JLP account debit to bank. Again what is the surrender value in 2020? 2000 rupees. So can I say buy balance carried down 2000? So 3900 minus 2000. 1900 is the loss which has to be transferred to P&L. Not loss, basically expense. Next 2000 brought down. Again premium paid JLP account debit to bank. What is the surrender value given in 2021? 3600. So buy balance carried down. So what is the loss? 1400. Again the 3600 will be brought down. Sorry, 3600 will be brought down. And this is 1st Jan 2022, the year in which Black retired. So the partnership firm will get the surrender value as retirement is on. The partnership firm will get the surrender value in the year of retirement, and that was 3600. So what will be the entry? Bank account debit to JLB. In this way the account gets tallied. So basically just remember one thing: whenever the firm pays premium and the firm wants to show it as an expense, then the entry will be JLP premium account debit to bank, and since it is a expense, it is a nominal account, so P&L account debit to JLP premium. In the case of retirement or death, the partnership firm, in case of retirement, the partnership firm will get surrender value. In case of death, the partnership firm will get the maturity value or the policy value. Now when the partnership firm wants to follow asset approach, in such cases the entry will be JLP account debit to bank. Difference between the premium paid and the surrender value is profit or loss. And in this way, you are supposed to solve joint life policy problems. I hope you are clear with the concept. Thank you.